All right. Hey, everybody. I'm Serge Berger from The Study Trader. And over the past 25 years, I've seen a lot of different types of markets. And the one that we have seen for really the past 15 years or so since the GFC stands for Great Financial Crisis, 2008, 2009, has for the most part been what I would consider to be a trend-following market. Trend-following markets are markets that are best to be handled as a buying the dip opportunity. Trend-following markets, when it comes to the S&P 500, so large cap growth stocks, really is kind of what this index has become. Those type of trend-following markets are really difficult to beat with individual stocks. All sorts of strategies can be deployed, and it'll be very difficult to beat literally just owning the S&P 500. What I'd like to show you here in this video is why I think 2025 is going to be an unbelievable trading year. And when I say trading, I think a lot of people have forgotten what trading actually is. Trading is a two-way market type of environment. Trading is not something goes down 5% and I'm going to blindly buy it because things always go back up at a 5% dip. That's not trading. That is, if done well for the reasons appropriate, that's a trend following strategy. If done for the inappropriate reasons, which is where a lot of people fall, it's really speculative gambling and hoping things will go higher. But I think 2025 is going to be one hell of a trading year. And before I show you how I'm going to tackle this, I'd like to put this into some context as to why I think 2025 is going to be a trading year. Before we go into the why even though, let's set a little bit of perspective, even just from a performance perspective, in terms of what, let's say, the S&P 500 has done. This is really, I think, in my view, the appropriate index to be analyzing here because of the abnormal returns that this index has seen. And so I'm going to start off with a couple of charts that I think are going to really help us build a little bit of perspective. So as I'm recording this here in late November 2024, and I look back over the past 12 months, I can see year over year, as it's called, that the S&P 500, the SPY ETF, which is what I'm tracking here, has rallied about 33%. If I would have done this year over year about, as I'm recording this about 2 weeks ago, the S&P was up almost 40% year over year. I went back and I studied that performance itself and put this into some context. I couldn't find a period outside of some of the 1920s, 30s periods where things were very volatile, where the S&P had any 12-month stretch. And I'm not talking about January through December. I'm talking about any 12-month stretch that would come anywhere close to this type of performance. And this type of performance has now taken place on top of an already unbelievably strong market over the past number of years. In fact, if we look at a 5-year return, we can see the S&P is up 105%. And over the past 10 years, the S&P is up 244%. So we're seeing a continuation here of unbelievably strong trends, which is ultimately translating into more momentum. And keep that word momentum in mind. We're going to come back to that here in a couple of minutes. But if we look at this and just look at the past, let's call it 6 years, on the regular weekly chart of the S&P 500, that's all this is. It's just an analysis of price for now. We're going to go deeper in a minute. You will see that we had a period in the year 2000 through the year 2013, the early part, March, where the S&P 500 did nothing. We had 2 bear markets and 2 bull markets. So 2 cyclical bear markets and 2 cyclical bull markets in that time. But most people that are currently in the gambling fever of the markets, I'm going to put it that way, have long forgotten about that period. Many even don't even recognize that it existed because some people haven't been in the markets since more than a few years. Of course, people that have been in the markets for longer, they will remember, but it's a distant memory. And, as my friend likes to call it, memories run short. Typically about 5 to 10 years is about what most people will remember. But of course, in the context of history in the markets and as a student of history, that is really not a whole lot of context. So is it possible that the S&P 500 could fall back into an environment that we had between the year 2000 and 2013, which were real trading environments? And I'm going to argue the answer is yes for a multitude of reasons, which I'll walk you through. But before we get to that, let's look at a little bit of price activity here, just to kind of give you some context why I think we are in the last leg of this very large and an extended secular bull market that started really, from a breakout perspective in March 2013, and we're now about 11 years into this. We could argue goes back a bit further, but that's about kind of where we are. And so, the initial leg of the rally is when there were a lot of people doubt, and then it continues to go, and we get a bit of volatility. And of course, we had some volatility in late 2018. There was some Fed mistakes being made. Then, of course, we had COVID, which was really probably the reason why we have such an elongated secular movement here. But let's just look at the last two legs of this bull market and see if I can make the case that this might have been or maybe the last one. So if we take, this is very, very simple, just line drawing, right, for context. If we take the last rally that started all this, which was in March 2020, so of course, COVID, and we just literally measure that. All I'm doing is drawing one line. It's kindergarten stuff. And I'm going to literally duplicate this line. So I'm not redrawing. I'm literally taking it, and I'm going to add it to the lows of the higher lows of October 2022, where the latest rally started. You can see that we are now exactly at the point that measures the rally of 2020, March 2020, to December 2021. And at that point, we had 2022, which ultimately from peak to trough in that we had about a 27, 26% drawdown in the S&P. But as things go, monetary and fiscal policy were such that we continue to throw just a lot more money at problems. No one wants to see a recession. Economists think they can bend economic gravity, which of course ultimately always ends badly. And we had another opportunity to blindly buy the dip. Technicians in hindsight will say, oh, that's great. We held at the Fibonacci levels, and that's all true, by the way, right? We held at the 50% retracement. That's actually not a Fibonacci level, but from the lows of March of 2020, COVID, to the highs of December 21, we retraced exactly 50%, just a 50% retracement. And of course, we're off to the races. Given the context of this, at some point we should get from a valuation perspective to a point where valuations in the markets will once again matter. And so when I look at historical valuations, and this is again where the history comes back in, I have this little chart to show you, and this is just 1990 to 2018, just to give you, about a 28-year span of history of valuations. You can see that the S&P 500 at its absolute peak in 1999, heading into the year 2000, its forward PE was for a brief moment actually north of 26. As we are currently looking at the market here in late 2024, the forward PE for the S&P 500 over next year's earnings, 2025, is probably somewhere closer to 22.5, 23. That doesn't make it as expensive as what we saw in 1999 heading in the year 2000, but it certainly makes it very expensive relative to most other periods that we can compare this to. Valuations don't matter until they matter, but it's very difficult to see the forward PEs grow a lot more, particularly if interest rates don't come crashing down here at this point. We have an environment where we are very likely to see, according to our analysis, higher inflation for longer, which ultimately will dictate a different portfolio. But while that's true, we think because of this, because of the where we are, maybe seventh or eighth inning in the bull market, secular bull market, and then of course an incoming new administration, global dynamics of geopolitics. We think there's going to be a lot more volatility. Notice I'm not calling for stock market crashes. Those are low probability forecasts to make in the first place. But we could absolutely envision a situation where the equity market, instead of making 25-30% a year, which is completely abnormal to put this into historical context, falls back into a prolonged period of essentially moving sideways in a very wide range. In fact, if you go back to the year 2000 to 2023, that sideways period that I mentioned before, and just for math purposes, it's a 12 and a half year or 13-year period of sideways movement. 13, right? I thought most people can't even comprehend not making money for 6 months. So a lot of people are going to get caught on the wrong side of the trade here. But that trading range was literally 100% to the upside and as much as 50% on the downside. So we're not talking about a sideways market where the S&P doesn't go anywhere. We're talking about a range-bound market, and they tend to be more volatile, more rich of opportunity. And so when we take all this together, I'm very drawn to this type of a market because for the first time in about a decade, I'm expecting a real traders market, probably not just for 2025, but also for a number of years thereafter. Real traders markets, as I said at the beginning of this video, are consistent with higher volatility, where people who try to buy the breakout get caught out because it's already overbought, and people who try to short or sell the breakdown below their simple linear analysis get stopped out because at that point it bounces again. That's a real trader's market, and a lot of people have forgotten or never even learned what actual trading is. Again, as I said at the beginning of the video, buying a dip because something's down 5 or 10%, that is not trading. That is, at best, trend following if it's done right, and at worst, for most people, it's basically just hoping things go back up after a little bit of a drawdown. That's not trading. A lot of people, unfortunately, do really badly. So for me, I'm expecting 2025 to be very much a trader's market. And what we've already seen in 2024, actually, is indeed a trader's market develop, less than I'm expecting in 2025, but it has a lot to do and comes back down to understanding markets, understanding that there will be trends, bullish trends, and there will be bearish trends. And those trends can be exploited with momentum. So when I looked at the market in the first quarter, heading into the second quarter of 2024, and I started looking forward, I did a lot of macro analysis, anything from our fixed income forecast to global equity markets to global cyclical analysis to interest rate analysis, taking currencies, taking political and geopolitical cycles and secularity into account. We came to a conclusion that at some point towards the middle, maybe even before then, part of 2025, we are likely to start to see it very obvious, even to the untrained eye, that the market is no longer just going to hockey stick from the lower left to the upper right. At that point, of course, it'll be too late for a lot of people to still save their portfolio, so I'm trying to get ahead of this. So first of all, knowing that there is a volatility ahead, and again, I'm not calling for stock market crashes, like I said before. That's always a low probability forecast, although it always can happen, right? So it's certainly possible. But we're just calling for heightened volatility for, again, multitude of reasons. One reason being a new U.S. administration that is going to bring a whole lot of headline risk, a lot more unpredictability to the markets. We saw a little bit of a precursor of that in 2016, heading into 2017, 18, 19. And we think that is going to, however, be even further elevated this time around because of the constellation of not only the White House, but also Congress, right? And so we think that is going to be leading to a lot of opportunity, but again, a lot more opportunity from a trading perspective. And it'll be even more important to be in the right sectors and to be diversified as an investor, right? So that's as an investor, but as a trader, there's going to be a whole lot more opportunities, we think. And it's all down to momentum. If I look at our TST trender indicator, which is really at the root of what dictates momentum trades for us, and we just look back literally just 12 months or touch more here as of that I'm recording this, and I'm looking at literally just the signals that it gave us in the S&P 500, the SPY, or the S&P 500 futures. They would be the same signals. I can see that over the course of 12 months or so, I got 1, 2, 3, 4, 5, 6, 7, 8, 9 signals so far. And if I add up these momentum trades, how much less nervous and clear-cut this is than having to constantly adjust and trade and doing this and that based on a lot of essentially guesswork. I think that's really going to be the key here going forward. So let's just look at these 9 trades that I mentioned and what they would have come to. So the first trade ultimately would have gotten stopped out for a full gain of 17 or almost 18% over the course of a number of months in the S&P 500. Imagine what a single stock would have done on that. That's the S&P. Then there was a short signal that lasted for a couple of weeks. We always like to reach what's called a free trade target, meaning we have a first target for any stock, or in this case the S&P, to reach, at which point we have a free trade and then we use a trailing stop. So this one reached the free trade target, then gets stopped out for the remainder for basically a scratch trade. Then the next trade came in the spring of 2024, which ultimately got stopped out for a gain of another 7%, right? I personally was completely against that move, but the market dictated it, momentum dictated it. The machine's algorithms, which are going to be even more active in this coming year and the years ahead, are basically dictating these markets. So that's another 7 or so percent on top of the 18 or so percent. So now that's 25%, and having been out of the market there for a while when it was consolidating. Then we had another target reached for this one. Actually ended up being a few percent of gains. Then another target reached. Then we had a losing trade of about, I believe, 3%, and then we had another long entry that ultimately gets stopped out for a gain of 3%. Then a trade right before the election, which we wouldn't take trades right before the election, not until after the election, and then a trade literally right after the election that, so far as I'm recording this, is working nicely. So we have captured most of the alpha of the S&P 500 with a lot better risk management than just being long and believing and hoping that things go higher. As we go into a different environment here in 2025, I strongly believe that we're going to start to see swings that are way bigger than this, because this is just the S&P 500. And to show you just a little bit of what this could look like, I want to show you what shares of United Airlines look like. This is ticker symbol UAL, and you can see we received a momentum sell signal, and then ultimately the stock reached its free profit, its free trade target, and ultimately got stopped out for a full gain of about 13-15%. And then it turned into a buy signal. And that buy signal wasn't just because the market is something that has to be bought when it drops 5%, but it's because there was new momentum coming into the market. And then you can see the buy signal, and as I'm recording this, the stock is now up about 120%. Imagine 120%. Imagine if all I did is buy a call option. That's literally thousands of percent of gains that I could potentially have with one trade. Imagine doing this with futures. So again, I think we're heading into a trader's market, and a lot of people have either forgotten what that is because we haven't had one in many years. I personally don't think we've had one. We had a little bit of a trader's market in 2022, but I think ultimately we really haven't had a real trader's market in at least a decade. So memories run short, and a lot of people don't even have never even seen a trader's market because they haven't been in the markets for 10 years or 15 years. And so this is the opportunity set. Looking at this another way, we can look at, for example, what might be the opportunity set on an intraday basis. So here we're looking at the NASDAQ 100 futures. Again, this could be the QQQ, this could be an ETF, this could be, whatever. I happen to like 5-minute charts on an intraday basis. And you can see the NASDAQ 100 here over the course of this 5-minute chart. It gave us a buy signal, reached its profit target right there. That's the free trade target that we go with. And then, well, that's the final target actually reached in this case. It's an intraday chart. And then ultimately gave us a sell signal. Sell signal, we reached the initial profit target, and it makes another 62 basis points. Again, these are intraday moves. That first move that made 2%. That's, with futures, if you're familiar with futures, or if this were options, these are ginormous moves. So expect 2025 to be a trader's market. That is our base case. And I think it's important to have the right tools. The right tools are not listening to someone who has never seen a market they don't like. If you listen to analysts out there, most people that you follow that make the mainstream news, the popular mainstream financial TV media are what we call perma bulls. They are cheerleaders for their own companies. They have to. That's the business they're in. They can't be bears. And it's not about being bearish or bullish. It's about being realistic about what the opportunity set might be. So please make sure you get yourself mentally ready for the possibility, I think the strong possibility, that 2025 is going to be a very different type of market than what we've seen for the most part for the past 10 to 15 years. And we need to be open-minded to that. Again, hopefully this has been helpful for some context. I think momentum from a trader's perspective is going to be very important to know how to do that. Again, even just preparing now for 2025, I haven't traded this much over the past few weeks in preparation for this, and there's already a lot of opportunity. As we head here towards trading wave, I haven't traded this much as I have over the past 2 weeks, annualized in, again, probably at least 10 to 12 years. So I'm really anticipating 2025 to be a very active trading year, but a very clear-cut trading year where momentum strategies are going to work like a charm across asset classes, certainly within equities, certainly within futures and options and ETFs. I hope this was helpful, and I wish you a great start to 2025.